Hello, hello. So we continue our series in which we are examining ARKK, the ETF innovation ETF from ARK, which is Cathy Wood behind that. And previously we talked about Roku and Tesla, so I have made a couple of videos before. In case you haven't watched those, I will leave a link for both of these in the description box below this video. You can watch them after you watch this one if you like. So now we're gonna take a look at the third holding of the ETF, which is Teladoc Health, and the fund consists of 6.53% of Teladoc here. So let's take a look at that company, see how it's doing, and if Cathy Wood is actually has stuck to her plan, we are probably looking at a company that's not making money, I would assume. So. Wow, the company has been down 75% in the last year, and it's a healthcare tech company, innovation supposedly. That's a massive drop here from 307, almost $8 here to 73. Wow, people must have been burnt here. So let's take a look and see whether it's actually interesting to buy now. Outstanding shares. Yeah, they keep increasing. It's something that you expect from supposed innovation. They keep increasing their stock, the outstanding shares, and so diluting investors massively here. This is from 2016, 15 here, actually 16. They have printed 120 million shares from 40 million. They have printed 120 extra. It's like 4 times as much. Wow, insane. So let's take a look now at actually the first thing. Another thing to notice here is the short interest, which is 14% almost. So and it has actually dropped. It used to be more. So yeah, at least it's dropping a little bit. So maybe there's not much of a potential for a short squeeze here too. Now let's take a look at the income statement, see what the company is doing here in the last about 5 to 6 years is probably fair. And yeah, innovation, I mean, I suppose you would at least look at some year-over-year growth, which is the case. I mean, the company grows its revenues from 200 million here to 1.8 billion in since 2017. That's pretty good. So especially last 12 months in 2020 have been pretty good for the company. But the operating income loss here, and what about the net income here? Yeah, from losing 100 million to losing 800 million. This is the typical story for these kinds of companies. Keep increasing their revenues, keep increasing their profit, and then their gross profit, but then losing money, more and more money actually year over year. That's something that I really don't like seeing, because I don't know how they can reverse the situation really, and if they can reverse the situation. So total assets of the company, they keep increasing here. I'm assuming this is a lot of stockholders' equity here added, because actually shareholders bought stock. That's what I mean. And a goodwill of $14.5 billion. That's absolutely insane here. I'm not so sure why this is that much. This is intangible value. Does it have to do with patents or anything of that sort? I'm not sure, but you'd have to extract that for the most part, because it's probably something intangible here. And this really skews the numbers of the total assets over here. And so the total equity of the company at 16 billion, and a lot of that again, it's because of the goodwill. And the common equity over here has been increasing, and additional paid-in capital company has been selling stock after stock after stock to investors over here. 16 billion, 17 billion, insane printing of stocks when the stock price was actually high, and they were selling heavily, massively diluting investors here. And so what about the cash from operations? It's in the negative. At least it's getting a little bit better, although it used to be the same in 2018, so not much better. Cash from investing, they still acquire some companies, I suppose, and a little bit of debt, but they don't issue that much debt, as they like actually selling stock, issuance of common stock, and this is how they fund themselves for the most part. And free cash flow that's in the negative here or close to zero. Company is not really making money, so this is basically zero. And an $11 billion, almost $12 billion market cap. Multiples that are getting a little bit better than what they were, that's for sure. And profitability, which is in the negative, of course. Solvency is probably going to be low here. Yeah, I would expect that just because of the assets that the company supposedly has there. So this is very low. However, if we take a look at the balance sheet, and this is what we really want to examine here, we want to see the total liabilities, which is 1.6 billion. That's not much, but they don't make any cash flow, so their cash flow here was negative. So at some point they will have to attend to these liabilities, and hopefully they can return. They can actually become profitable. They have some profitability years, like 2019 was the only one here, and I'm assuming this is when the company has started to skyrocket. And we can actually take a look at the chart. This is what typically happens. Yeah, 2019, at the end of 2019, it started going higher and higher because of profitability, I suppose, and then it actually lost money again. And then actually crashed because the company just doesn't make enough money to sustain the valuation. Like, imagine, this was $12 now, it has dropped 70%, so it was like 4 times as much as it is now, more than 4 times. So the market cap was like at $60 billion at some point, which is absolutely insane for a company that doesn't make any free cash flow at all. And so this is what happens when you own these kinds of companies that don't make money really, and the economy enters a sort of like downturn, or the stock market enters a negative sentiment, and people start selling stock. This goes down, and the problem is, will it ever come up again? Because it doesn't have anything substantial to support the retraction and actually coming back to normal levels, to previous levels really. There's not really normal here. They're way overvalued. But as it is right now, I wouldn't invest into Teladoc. I'm pretty sure CATHIE will, but I wouldn't, because the company doesn't make any money. For some reason, it has some amazing goodwill there that skews the assets, and projections are not looking great either. I mean, I don't know. It seems like it's getting a little bit better, but then I'm seeing like negative VPS, although it is becoming less negative, I guess. So that's better for sure. But the thing is, how much are you gonna spend for this? I just don't have a clue, because it's losing a lot of money, and it has lost a lot of its value, so the downturn may continue. Now, if it really falls way lower and keeps falling, maybe at some point it may be a little bit of a ticket that would be interesting to take a look at and maybe buy. But there are so many other like healthcare companies that can really fall very quickly. The healthcare industry can really fall very quickly, and so this is what happened with this one. So I would avoid Teladoc, but it was useful to examine what CATHIE is buying again, just to know what to avoid potentially. So hope you enjoyed this one, and if you did, I will continue making similar videos, and the next one is going to be about the 4th largest holding of ARKK. In this series we kind of examine the top 10, maybe even more if people like this specific series in which we're discussing ARKK. People seem to like this one, so I will continue making more videos if they do. Thank you for watching this one. If you did like it, please leave a like and subscribe. And in the meantime, you can take a look at this video that I made earlier, and it's about inflation and how it works, what you should be careful about. And I'll see you soon. Bye-bye.